Welcome to today's session, Imst versus MSTY, a deep quantitative comparative analysis. Or as I like to call it, two wildly different ways to harvest option premium from the most dangerous, absurd, and completely deranged stock on the US equity markets. Strategy. And calm down, that's a compliment. MSTR is a derivative of Bitcoin itself with corporate leverage duct taped on top. The ETFs we're about to explore are financial engineering products designed to ride this volatility dragon and either gently steer it toward long-term wealth or milk it for monthly premium until the dragon eats you alive. The difference is subtle, but the consequences are profound. This is volatility monetization at its most weaponized form. My name is Adam Livingston, and I am your #1 source for Bitcoin and Bitcoin Treasury Company analysis. If you want access to the most cutting-edge information during the most important wealth transfer in the history of humanity, please like this video and subscribe to my channel. And remember, this is not financial advice, this is financial entertainment. At surface level, these two ETFs look identical to the average investor. Same underlying asset, strategy, both sell call options and both print distributions. But under the hood, they're operating with two completely divergent philosophies. The financial equivalent of two hedge fund managers sitting at the same roulette table playing two completely different games. On one side, you have Imst from Bitwise, built for total return optimization. A fund that tries to outthink the market's volatility cycles, dynamically adjusting strikes, spacing tenors, and allowing some upside to flow through while siphoning premium during periods of volatility compression. It's basically volatility farming, but done by people who understand that volatility itself is a living organism and you don't want to poke it every 7 days. On the other hand, you have MSTY. This is the yield maximization machine. Weekly contracts, tighter strikes, heavier premium capture, pure monthly income printing. With the explicit trade-off that when strategy goes vertical, your upside vanishes instantly. Not all of it, I know, but you are selling a lot of it for cash flow. One structure is trying to play chess against the chaos. The other is selling gamma hand over fist and praying the dragon does not come out of its cage. Both of these funds exist because we live in a society that is both desperate for yield and deeply addicted to gambling on volatility. The only question that matters is which level of risk delusion are you most comfortable with? Why strategy? Simple. Strategy is a publicly traded Bitcoin volatility vehicle, legally wrapped, SEC compliant, with corporate leverage added on top like lighter fluid. Its 30-day implied volatility often exceeds 100%. Its correlation to Bitcoin is nearly parasitic, and the options market is a liquidity geyser. This is not Apple, this is not Johnson & Johnson, this is the financial equivalent of riding a mechanical bull with rocket thrusters. Every movement in Bitcoin translates into amplified leverage swings in MSTR. That makes it a perfect volatility harvesting laboratory. The implied premiums baked into these options are so rich that both funds, IMST and MSTY, essentially exist to exploit one simple reality. People are willing to overpay for the right to speculate on MSTR's next move. And these funds are here to sell them that privilege again and again and again. Now here's where it gets beautifully schizophrenic. Two products, same raw ingredient, MSTR volatility, but entirely different recipes. IMST says we're here for total return optimization. We'll adapt. We'll dynamically adjust strikes based on market conditions. We'll avoid selling our upside for a few cheap dollars. We'll stay patient and let volatility compression work in our favor. Meanwhile, MSTY says screw patience, we'll harvest as much premium as we possibly can every week, tighter strikes, shorter tenors, maximum income right now. If the stock rallies too far, who cares? We've already collected the rent. Bitwise's IMST behaves like a hedge fund trader studying volatility clusters and dynamically repositioning. MSTY behaves like a volatility farmer who doesn't care about upside, just wants to squeeze monthly cash flow out of every cycle, regardless of where the stock might go. Neither approach is dumb, but they are designed for completely different psychological profiles. IMST, the allocator who wants to monetize volatility without losing the upside lottery ticket. MSTY, the allocator who wants monthly yield and has made peace with selling their upside to get it. You're not choosing between good and bad, folks. You're choosing between which financial drug you want to be addicted to. Let's break open the IMST machine. It's brilliant because the head of alpha strategies at Bitwise is Jeff Park, and I'm pretty sure that guy leaves things in the toilets that can do math better than I can. This fund does not buy shares of MSTR. It synthetically creates long exposure by combining long call options, short put options, and collateral cash in treasuries. In short, capital efficiency. Instead of putting up the full price of MSTR stock, it builds the position for a fraction of the cost, freeing up capital that sits in a safe, boring T-bill while the options do the heavy lifting. Then comes the income layer, writing call options on top of this synthetic position. And here's where IMST separates itself. They do not blindly crank out weekly option sales like a YieldMax robot. Instead, strikes are dynamically adjusted based on where volatility sits relative to historical ranges. The team constantly recalibrates how much upside they're willing to sell, depending on whether option premiums are actually compensating them for the risk. When volatility is cheap, they sell further out of the money. When volatility is rich, they pull strikes closer. It's essentially volatility regime management, adaptively sizing your greed based on whether the market is offering you good or bad deals. And most importantly, they intentionally avoid short-dated weekly options. Because when MSTR gaps up 20% in a day, which it does often, short-dated calls get run over instantly. This is intelligent premium harvesting. It sacrifices a bit of yield to preserve your right to participate in the full insanity that MSTR occasionally delivers. Now let's flip to MSTY. It is built for one job: extract maximum yield every single month, no matter how dangerous it gets. It's like a factory where the only KPI is monthly cash flow. Here's how it works. It also builds synthetic long exposure like IMST. But instead of carefully optimizing strikes based on volatility regimes, MSTY just goes straight for the jugular. Tighter strikes and heavy reliance on weekly options. Why? Because weekly options bleed theta at maximum speed. The closer you get to expiration, the faster the premium decays. And MSTY is positioned to catch as much of that as possible. The trade-off is you dramatically increase your chance of getting capped on any major upside move. If MSTR spikes 25% overnight, which again, it absolutely can, MSTY's upside is already gone. You collected your weekly premium, but the NAV can't participate in that breakout. This approach is perfectly suited for investors who don't care about long-term capital growth. They want pure income. They're essentially selling their participation in upside rallies in exchange for big monthly payouts. MSTY is the purest form of volatility farming. Get in, sell gamma, collect checks, and pray the stock doesn't melt up when you're capped. Weekly options are seductive. You get faster premium decay, more frequent payouts, and bigger headline yields. But the cost, you are selling gamma exposure at maximum risk density. Let me translate that. When you sell short-dated options on something like MSTR, you're betting every single week that MSTR won't explode upwards in the next 5 days. But MSTR isn't Walmart, it's a Bitcoin-embedded volatility grenade. 20% upside gaps do not happen here. They happen monthly, sometimes weekly. When you're constantly short weekly calls, you are repeatedly inviting catastrophe. You collect rich premiums right up until the moment MSTR rips vertical and your options get steamrolled. IMST avoids this completely. It extends tenor, spreads out assignment risk, and preserves enough distance for some upside participation when MSTR inevitably detonates. MSTY leans into risk intentionally because its mandate is different. It's structurally sacrificing upside lottery tickets in exchange for a yield stream that looks great on paper until you chart the missed NAV growth after a major rally. This is why the difference isn't about right or wrong. It's about understanding how much of your soul you're selling to maximize monthly income. Let's walk through exactly how these structures behave across 3 core regimes. Scenario 1, the blow-off rally. MSTR up 25% in a single day. IMST participates meaningfully in the move. Out of the money strikes still have distance. Upside partially captured before hitting the cap. MSTY is fully capped almost instantly. Weekly short calls get called away early. Upside is gone. Premiums already banked, but you missed the real money. Scenario 2, sideways chop in high volatility. IMST harvests respectable premiums while preserving flexibility. MSTY dominates yield production, constant theta bleed at its most efficient. This is MSTY's perfect environment. Scenario 3 is a sharp decline. MSTR crashes 30%. Both funds take NAV losses nearly in full. Option premiums soften the blow slightly, but neither strategy immunizes you from core directional beta. The illusion of high distributions can sometimes mask how badly NAV is decaying underneath. This is the cold reality. These funds don't eliminate risk, they simply reshape it. You are choosing which version of volatility pain you want to monetize and which version you're willing to endure. Now we drill into where IMST separates itself structurally. Volatility isn't static, it breathes, it expands, it contracts, mean reverts, and overcorrects. flex. Most covered call funds ignore this and sell the same strikes on autopilot. IMST does not. It continuously evaluates where volatility sits relative to historical norms, whether option premiums are compensating sufficiently for the risk, and whether MSTR is entering a potential breakout or breakdown regime. And most importantly, it alters strike selection accordingly. When volatility compresses, IMST moves strikes further out of the money, sacrificing some yield to retain upside convexity. When volatility expands, it can afford to sell closer strikes and still capture meaningful premium. This is volatility monetization optimization. The fund isn't just selling options, it's actively arbitraging the structure of volatility itself. This is how you prevent yourself from becoming the bag holder in a covered call ETF that underperforms dramatically during bull markets. You monetize volatility without permanently selling your participation in upside chaos. Now here's where the institutional flexibility kicks in. The parts of the option market retail never touches. IMST is not limited to trading what you see on your brokerage app. They're using flex options. There's European-style settlements, which eliminates early assignment risk entirely. There's custom strike prices. They don't need to play only at standard round numbers. And there's custom expiration dates. They're not chained to the traditional Friday expirations. This unlocks enormous precision in how they construct their positions, tailoring strike distance to exact volatility bands, avoiding the forced cliff of weekly expirations, and building structurally superior risk-reward convexity across time horizons. The public option chain only shows you a small slice of their actual positioning. This is not a retail options wheel strategy scaled up. This is highly engineered volatility harvesting built on institutional-grade derivatives plumbing. Let's simplify everything we've just covered into the decision tree that matters. If you're sitting at the capital allocation table, these are your choices. Is long-term capital growth a priority for you? IMST might be your better option. Are you actively harvesting volatility? Yes. However, remember MSTY probably has the better yield upside. What's your tolerance for capped upside? IMST, obviously you're probably going to have a better upside with MSTY. There's a full cap. Do you have willingness to sacrifice short-term yield for longer-term NAV optimization? If so, IMST is your answer. MSTY, maybe not. You're not choosing between good and bad, you are choosing between instant gratification and compounded asymmetry. And you better know which game you're playing because MSTR will test both, guaranteed. Both funds weaponize the same raw material, MSTR's embedded Bitcoin volatility. MSTY is a yield factory. IMST is a volatility optimization machine. The wrong question is which fund pays the highest yield next month. The right question is which structure best matches time horizon, volatility regime, and risk profile I want my capital exposed to. Because once you're trading volatility on something like strategy, you're not just investing anymore, you're managing chaos. And chaos doesn't care about your need for steady distributions. I hope I'm clear. I better not hear a single question of, which one should I buy? I don't know you. I love you, but I'm not allowed to give financial advice. I'm allowed to give out financial entertainment. If you enjoyed this presentation, please subscribe to my YouTube channel and like this video to support my work. Leave a comment with what you want to hear me comment on next. Have a terrific day and do not party too hard.